Okay, welcome to our May monthly Matt Chat part two. Some of you probably saw the first edition of this, but we're re-recording it because it didn't record the first time. So here we go. We're going to go through our normal progression through the markets, treasuries, the economy, the Fed, investments, and then some takeaways. So the market, although the last couple of days it's been down, again, the benefit of hindsight and being at these charts a couple weeks after we originally recorded it. So one of the things I did talk about is to expect that the market will come down again. And today we had some tariff news with Apple, and that's brought the market down a little bit. The treasury yields, again, they were getting up pretty high. Today, as the market came down, it brought Treasury yields down a little bit. I do expect that that will continue through the rest of this year. We'll hit a peak at some point and start coming down, and that'll drive Treasury values back. The deals with China and other countries eliminated the news about how negative tariffs are and the market up. Again, I think over a short term, at some point, good news isn't going to be good enough to push the markup up any higher. And I feel like that's kind of the point we're at right now. So we should see through summer the market start to deplete. VIX, so you'll see the volatility index got way high around the end of April, beginning of May, which we had talked about 2 calls ago that we expected that to happen. It's back down to a normal level. I do expect that it'll pick up through the summer and we'll see that volatility mostly to the downside continue. Our vidometer is holding steady, although with inflation numbers coming in incredibly low, the lowest point in years, I do expect that we'll see some movement with the Fed. They'll likely be forced to make some cuts here over the next quarter or so. And referencing inflation, here's our trueflation number down at 1.5. Look at this chart. Just over the last 12 months, we down at or near our lowest point, and things continue to go that way. In fact, we're heading into the holiday weekend here, and gas prices everywhere other than California are at their lowest point, inflation adjusted, back to the early 2000s. Gas is looking good, right? Gold continues to follow that upward trend. It's getting a little bit more volatile at the top where we have some big swings, but you'll see it's up over 38% for the last year. I do expect, again, as we see volatility in the market, that you'll continue to see gold, the overall trend, rise. Silver's been a little bit different story. So you'll see 15% for the year, and you'll see that significant drop in April. Silver quite a bit with the stock market. So it's a very good opportunity to be able to get in and probably have larger gains as a hedge against the market than you would with gold at this point. So this is a review of what we talked about in our last call. It's not all about tariffs, the 5 areas to fix the economy. So again, tariffs have been the big bad word. They've been painted in the media as a bad thing for the economy, which long-term tariffs can be a bad thing for the economy. In this scenario, however, I believe they're just being used as leverage to create deals with other countries, which we've actually seen play out with China most recently, India, and I expect that that will continue to be a tool going forward. Tax cuts, at the time this was originally recorded, there weren't any tax cuts. There still aren't, but they have been voted for in Congress. We still have the Senate to vote, I would guess, over the next couple weeks. And we should see no tax on tips. We should see the largest tax cut for everyday citizens. The numbers I was seeing was anywhere from 8 to 13,000 in tax savings per average taxpayer. So we could see those be implemented in the next month or so, maybe by the time we do our next call. Regulation, one of the biggest drags on the economy is the amount of time it takes from when a project starts. So I'll use, for example, building a factory, which we have tens of trillions of dollars of new money coming into the US to update and grow our manufacturing sector. Under previous administrations, the regulation to do that from the time you started a project to the time it was operational would be years, just getting through all the red tape. Anybody who's tried to do a remodel, build a house or anything like that, you know how many different hoops you need to jump through just to add a little bit of square footage to your house or even just upgrade your house. So across the board deregulation needs to happen to allow common sense things to happen on common sense timelines. Number 4, reduction of wasteful spending, and specifically DOGE. We've seen them go in and find wasteful spending across the board, whether it be Social Security and folks who should not qualify for Social Security receiving it, folks who are over 120 years old receiving it. There's been a lot of wasteful spending in that way. Now, one of the points I made the last time we did this is they're going in and they're cutting what looks like something that needs to be cut or that's not effective or is being sent in the wrong direction. And they're finding that at times cutting with a hatchet has created some issues where certain programs are not getting fully funded, which are good programs that are helpful. And so they're going back and replacing the funding for those programs. Unfortunately, with all the waste and corruption, for lack of a better term, within the system, they need to use that hatchet and then go back and replace things. That being said, this is the beginning cycle of cleaning your house, and once the house is clean, they can start fixing where they might have gone overboard. And finally, interest rates and Fed policy. So there's 2 different levers for reducing interest rates. Lever number 1 is when the stock market drops, it creates a flight to safety. One of the safest investments is treasury bonds. When people buy treasury bonds, that drops the yield. So as the price goes up, the interest rate that it pays goes down. Number 2 is Fed. The Fed can go in and they can cut the rate to borrow money. It's very important that interest rates do drop. And the reason is we've got 36 trillion in debt currently and over $1 trillion just in interest each year on that debt. So that just continues to compound and grow and become a problem. The reason we need that to go down is we've got over 8 trillion in treasuries that will be refinanced just this year in 2025. And if we can reduce the interest rate that is owed on that, the amount of interest we're paying by hundreds of dollars a year, which is money that then can be redirected to paying off debt. So that tells me that interest rates need to come down, whether the Fed is the tool that does it or the market dropping is the tool that does it. There's going to be a drop in interest rates. And it may be that both levers are pulled at some point. So that's a big factor for the philosophy of what what we do. So our takeaways, just continue on the same path, expect that interest rates are going to come down, that the market is likely going to be at a lower point 6 months from now than it is now, and potentially significantly lower, which creates opportunities to shift towards those dividend paying stocks in the future. That's it.